Hello all, welcome back to UPSC Warriors channel by Unacademy. This is Soundarya. I hope you're all doing good. So in today's video, we are going to study the key differences existing between debt and equity financing. So this topic is again a very important topic under your capital market and quite confusing as well. When I was preparing for UPSC, I had, often get confusions with respect to the debt and equity financing and the elements. So today we are going to study in detail about the key differences and the applications of debt and equity financing. To start with, both these financing are a part of capital structure of a company. That is, if at all a company wants to raise funds for its investments, for its working capital, that is for purchasing any assets or for purchasing any machinery, then it has to, either take up debt financing or go for equity financing. So in common, we have both these financings as the techniques used by the companies for raising investments. And how do they differ from each other? Let's try to understand it in detail now. So under debt financing, we raise money through borrowings. Okay, so we get loans either from the banks or we borrow money from the capital markets by issuing bonds so as to finance our capital needs. So from whom do we get these loans from? Either from banks, from public markets. So if at all it is a bank, then you have to issue collateral. You have to submit your collateral. And if at all you are getting money from the public markets, then obviously you have to issue your company's bonds, right? Okay. And then for whom this type of debt financing is suitable? It is suitable for well-established business enterprises who actually have a proper track record of their financial transactions, especially borrowings and lendings, and who actually have the collateral with them. So it is not again suitable for startups. Why? Because startups are not that creditworthy when it comes to the banks for lending huge amount of money for their capital formation. And what do we have to repay here? We have to repay both the principal as well as the interest amount. So this is the fixed cost of your borrowings. Clear? Okay. So what is debt financing? Debt financing is as simple as taking money from the banks, taking loan from the banks. So how do we take loan from the banks? By issuing some documents as collaterals or security, and that will be used by the banks in case of what? Default. Clear? So now who can make use of this debt financing? Especially for the business units which are already well established. Now, moving forward to equity financing. This term equity is again something similar to stock. Okay, so under equity financing, we raise the investments, we get the capital needs by selling our ownership. It is not borrowing, but rather under equity financing, we will raise funds by selling the ownership. Say for example, if I have my company, okay, so in that company, if I am willing to raise funds, then I can go for equity financing where I will have to sell the ownership. That is, sell some of the shares of the company to the investors who are giving me the money. Say for example, I am selling this portion of my share. Say for example, it is some 10% of the entire ownership that I have. So I am giving this 10% share to the investors, those who are willing to invest. If 1% of my share is worth, okay, $1 million, then I will be able to get $10 million by just diluting 10% of the ownership. And again, how can we do that? You can get these investments from investments banks which are either new or already existing. To give some examples, we can give the examples of venture capitalists, we can give the examples of PE firms, we can give the examples of large corporates, so who are again investing in the company's stocks by purchasing their shares. And what you have to remember here is that it is suitable for the business startups who do not have proper track records, as I already mentioned, or do not have proper collateral with them for the banks to lend the loans. And what do we have to repay here? We have to repay nothing. Why? Because we are actually getting money by selling our shares. If in case the company is performing good, then the investor can either get a profit, that is, we will give them dividends, right? But if the company is not performing good, then again we do not have anything to repay back to the investors. So this is the difference between equity financing and debt financing. Before moving ahead, I have a very important announcement to make for all of you, that now you can get UPSC CSE Plus subscription for just 1200 per month, where you will be able to access the top educators classes in all the batches, right from Hindi, English as well as English batch, where you also have a dedicated doubt solving sessions, that is one-to-one doubt solving sessions. So if you want to avail further subscription, then you can use my referral code RIYA50. Now, moving forward from here. So what are the main advantages of debt financing and equity financing? Under debt financing, we do not have to dilute the ownership. Clear? And under debt financing, there is no direct claim of the ownership rights by the lenders. Clear? So banks cannot simply come and take out your ownership. So what are the advantages under equity financing? The two key advantages. One is there is no obligation for you to repay the money back. And second thing, there is no additional financial burden on the company. Now, moving forward from here, let's try to, sum up the differences between debt and equity financing. We said it is borrowing money for interest. It is selling the ownership rights to get the money, and then we can maintain the ownership here. Here the ownership is getting diluted. And third thing, we have to repay principal and interest payments, and here there is no need to repay, but just you have to distribute your profits. Now, what are the risk elements that we can find under debt financing, and for whom it is going to be risky? Under debt financing, it is going to be risky for the buyers. Why? Because if at all you are failing to repay the money back, since you are actually involving your collateral into that, banks can easily make use of your collateral to take your property or whatever that you have actually pledged, and it is less risky for the lenders because they have the security with them. So this type of questions are already being asked in your UPSC. Say for example, debt financing is suitable for or it is less risky for lenders, less risky for borrowers, like that. Okay, so then it is important for us to know it is less risky for the lenders and more risky for the borrowers. And then how about equity financing? Equity financing is less risky for the buyers and it is highly risky for the lenders, because if at all the company is not performing well, then obviously you will have to sell the shares that you bought for even more lesser price, right? So, and then there is one small advantage, that it gives you the dividend. But if the company is performing well, then obviously you will be able to get more amount of returns under equity financing. So, when can we choose this debt financing, or when we have to go for equity financing? We can choose debt financing probably when the interest rates are lower. Okay, so whenever you want to have cheap access to the capital. Why? This debt financing, although it is time consuming process, it is less expensive. Clear? When compared with equity financing, we say debt financing is less expensive, because equity financing is more expensive as it involves diluting your shares. Clear? So these are some of the advantages that you can choose debt and equity financing. And you also get tax benefits, because the loan amounts that the businesses get are tax deductible. So under these conditions, you can choose either you want to go for debt financing or you have to go for equity financing. Again, it depends upon the other parameters like the company's growth, the profits, and the capital that you need. What is the main purpose of capital that you need for, whether you will be able to make a fixed payment of the interest amount for the rest of the time period. So depending upon all these conditions, usually the companies will go for either choosing debt or for equity financing. So talking about equity financing, there is no collateral available. So if there is no collateral available, you have to choose equity financing. And when business expertise is needed, because when you issue ownership rights, when you are diluting shares, then we get the persons in for making decisions, because since they are also part of the company, they also have a voice in making decisions, right? So whenever we need such kind of expertise, then we can go for equity financing. And then when we want to avoid the fixed cost of making a periodic payment of interest, then again this equity financing is suitable. So this is all from my side for today. Before we end, there is a previous year question topic. Just have a look. With reference to the expenditure made by an organization or a company, which of the following statements are correct? So this is your 2022 question, and here it is talking about the expenditure. But then see, acquiring new technology is capital expenditure. And second statement reads, debt financing is considered capital expenditure, while equity financing is considered as a revenue expenditure. So first statement is okay. Acquiring new technology is a capital expenditure, that is true. But talking about the second statement, we know that both these debt as well as equity financing is done so as to raise our funds for capital investments, right? So obviously it is going to be a part of capital expenditure only, even this equity financing. Clear? So it is not about revenue expenditure. Why? Capital expenditure is any expenditure that you make for purchasing any assets that is needed for your production, purchasing any technology. Okay, so whatever that is involved in formation of goods and services, production of goods and services, can be called as part of your capital expenditure. One thing, the amount will be lump sum, and second thing, the investment is going to be needed for a long period of time. And talking about the revenue expenditure, it is very simple. What are all the expenditures that you make for your day-to-day administration or day-to-day functioning of the factory or the organization? That is called as the revenue expenditure. Clear? So what should be the correct answer here? It is option A, 1 only. So that's it for today. Thank you so much for watching. If you have not subscribed to UPSC Warriors channel, please subscribe and stay tuned with us for more updates. Thank you. Take care.